stock portfolio policy. There are two approaches in becoming an intelligent investor. The first one is the active approach. If you are like an avid competitive sports fan, then this would work for you. Active investing means to be always on the watch, always studying, and selecting your set of stocks and bonds. The second one is the passive approach. If you're more laid back, if you don't want to feel such pressure, and if you want to keep things simple, this is for you. Passive investing is to have permanent investments which you don't need to check from time to time. Both active and passive approach is intelligent. The key is to find the right one for you. Are you always craving excitement, or are you more attracted to calmness? After this step, you should decide how much you are willing to put in bonds and how much you are willing to put in stocks. Generally, bonds have lower risk but low returns. Stocks have higher risk and higher returns. Some equity experts say that people should decide based on age. They say that younger people can handle more risks and older people should engage in lower risks. For example, a 28-year-old professional should put 72% of his money in stocks. An 81-year-old woman should only put 19%. Graham dumps this idea though. It doesn't matter what age you are. What matters is how intelligent you are as an investor. Graham advises that investors should keep at least 25% in bonds anytime. That will protect you from unpredictable stock market. Let us take a look at two scenarios. Mrs. Smith is an 85-year-old widow. She has a monthly pension. She has several grandchildren to whom she wants to give inheritance. Mrs. Smith has $3 million in her bank. Meanwhile, there is John, who's a 25-year-old bank employee. He's looking forward to starting his own family. John saves money for the wedding and down payment for a dream house. Of the two of them, who should invest more in stocks? Who can afford to take more risks? According to the age assumption, it should be the older woman, Mrs. Smith, to be less risky. But she has more financial security than John. Graham suggests that all investors, young or old, should prepare for the unexpected. The stock market is unpredictable and so is life. Are you single? Do you expect to have children anytime soon? Do you have a stable income? If your financial situation is more like Mrs. Smith's, then you can afford 75% stocks and 25% bonds, or in cash. If you're more like John, then you should maintain your 75% in bonds and cash. An intelligent investor will not buy more stocks just because stock prices went up. An intelligent investor has patience and discipline. Look instead on your needs rather than the stock prices. Are your investments adequate to your needs? Graham advises to assess your portfolio every 6 months. This will prevent you from making any impulsive decisions and losing money. The defensive investor and common stocks. The defensive investor is someone who knows how risky stock markets can be and knows how he can defend himself against it. Bonds are often low yielding, so it is logical to own stocks at a price and amount that works for you. It is practical to keep a permanent autopilot portfolio, which is a set of stocks that you can always keep. Make sure that you have studied about the companies before picking them. Once you have that permanent portfolio, it will prevent you from always shopping for stocks. The number one rule for being a defensive investor and an intelligent investor is to do your homework. Be familiar with the company you're investing in and check its financial statements. Peter Lynch, who owned Fidelity Magellan, advises people to use common knowledge. The crowd piling for a new restaurant, toothpaste, or brand of jeans indicates that it is good business. Finding that promising company, though, is just half of the job. Next thing you should do is to study its financial statements. The actress Barbara Streisand is also popular for day trading. She represents how the majority of investors think. In 1999, she said that she drinks Starbucks every day, so she invests in Starbucks stocks. Buying stocks from a business that's familiar to you isn't enough. Another example of people who invested on Amazon.com just because they love the website, or the people who bought E-Trade stocks just because it's their personal online broker. Some people invest in a mutual fund company because its office building is around the town. Don't make the mistake of exaggerating what you already know. If you're over familiar with the company, it may be that you do not see its flaws. Don't be a lazy investor. Now, if you're a defensive investor who always does homework, this is a good time to buy stocks. You can take advantage of these tips, which would make investing easier and cheaper for you. First is to check on online broker websites. Some examples are sharebuilder.com and foliofn.com. These broker websites only charge $4 per transaction. There is no minimum account balance required to invest. You can arrange it so that you can put in money from your online bank account or reinvest your dividends. There are also companies who offer their stocks on their website. The advantage that you would not need a broker. Another useful tip is to invest in mutual funds. They are generally low cost and low risk. Mutual funds require little maintenance or monitoring. They are less likely to cause you any surprises or problems. As opposed to high-priced stocks, mutual funds are the safer and smarter choice.